Good morning. Welcome to Wayne's World. I'm Wayne, and you're in my world. Before we begin an end of the year topic that's going to be covered over several different sessions together, this is basically part one of a series because I'm focused like a laser beam on avoiding taxes like poison. Before we do that, I want to remind you, I've suggested it over the last couple of weeks, 1 week left to go to treasury.gov and purchase a I-bond paying 9.62% guaranteed for the first 6 months. Tremendous opportunity in a very safe environment in light of rising prices. And right now, 9.62% is beating inflation that's in the 8% range. Very few other safer investments can do that, believe me. So treasury.gov, and you can go from $10 to $10,000. A great way for kids, relatives, friends to pick up a decent rate of return. With that said, the IRS has many rules and regulations many people aren't aware of. In fact, there are several accountants that sometimes are not aware of some of the benefits that realtors get as part of various acts that have been put into place, the most recent one being done a few years ago under President Trump. So we'll take a look at things along these lines and go from there. I'll share just some thoughts and ideas, but first of all, you have to realize, I am not an accountant. I am not an attorney. I'm not an IRS enrolled agent. I'm a realtor who enjoys taking the benefits of the tax laws to legally avoid taxes. Tax avoidance strategies are what every person should be doing. The alternative is what gets people in trouble, tax evasion strategies. So we'll take a look at many, but basically I'm here just to provide information and to get you thinking to call your attorney, your accountant, other advisor you use in handling your personal business and financial affairs. So let's take a look at some basic things. And again, they're going to be very basic, but I may add a twist or two to some tips and techniques that have worked for me in the process and some of the pitfalls that I learned by an audit. And I have a theory: you will never know if you pay the least amount of taxes until you've been audited. Over the years, many times my audit triggered more deductions than I was aware of. And we'll talk about that a little bit later. So I know it's easy to make the money. It's harder to keep the money if you're a strong agent. If you're a beginning agent, it may be harder to make some money, but you still have to keep the money you make. So either way, the goal is to keep as much as you can so you can consume more, invest more, and hopefully buy at least 2 properties a year, which is another big tax break. With that said, very simply, let's look at about a dozen different reminders, commissions. Don't forget all the referral fees you pay out to other agents for referrals. All the other costs related to a referral. For example, if you took and met the referral agent for lunch and bought lunch. We're still in a phase right now, we'll see in a few moments, where you can write off 100% of your meals because of COVID. This is the last year that's going to be allowed. Again, commissions add up quickly. Again, you can write off what you refer out. Another one that I think is common sense, but gets confusing because some of you don't use the home office deduction to your advantage. There's a tax form, 8829. I'd suggest you write that one down, go on to irs.gov/forms and take a look at 8829. It's a detailed process of taking the deductions for your home office. Now, obviously, like the vehicle deduction, there's 2 ways of doing it. One is to keep meticulous records and take specific expenses. There's a simplified method that basically most of us are probably better off taking. But again, it's got to be an area used exclusively as your principal place of business, i.e., a separate, distinct area. I'm sitting in my office. This is used to see clients. I saw 2 people yesterday. This is used for me putting together programs like this. This is used to watch some shows on TV. I can get some ideas and tips to share with people. I've got books here. I've got materials here. This is where I function. Access to the internet, cell phones, landlines, everything here is a tax deduction. And there's several ways of doing this. One is the simplified method, which is a flat fee. On the other hand, the IRS has several other guidelines. If I have 10 rooms in my home and I want to keep specific expenses, a prorated share of my electrical, my snow removal, my furnace, my heat, I can keep specific records and allocate 1/10 of those expenses because I've got 1 of 10 rooms used for an office. If I've got 5 rooms and 1 is a home office, I could deduct 20% of all my actual expenses, prorated. So Form 8829, its instructions could be the first place to look. But also, some of you might be using some deductions from your company by your office there, your desk fees, etc. That negates the home office deduction. If you're taking your desk fees, you might have a problem using your home office as a deduction. That's why I suggest strongly you share these ideas and your questions to your tax accountant, to your attorney, and other people you feel could be beneficial. Maybe even someone in your company that handles helping agents do their best process for paying the least amount of taxes. But these desk fees, no matter where you're at, are deductible. But if you take that deduction, then you can't claim the home office deduction. So you can't have it both ways. My guess is, unless you got exorbitant desk fees, you're probably better off claiming the home office. Plus, in most cases, you're probably doing more work in your home office if you even go to your company. Some companies are functioning very well without basic offices or the same kind of office they used to have. And in some states, we're letting agents do things differently by license law. So please be aware of the laws related to offices in your state, city rules about offices in your home in a neighborhood. There's some legal issues you may want to make sure you don't violate in the town you live in for an office in your home. Signage may be critical, whatever the case might be. So you can't do both. I'm suggesting strongly, I've never used desk fees as a deduction compared to all the other expenses of my office or the simplified method. Now, here we are. Education in real estate is from womb to tomb. The womb was when you got your license, and you're doing this forever, or hopefully as long as you feel you're serving your clients. But education is very critical, whether it's live education, Zoom education, hybrid education, reading books, subscribing to a coaching program or a training program online, anything you do that's not training you for a different business. It could be a different license, a designation. So, for example, all my negotiation classes, all my seminars, all my lunch and learns with my partner, Michael LaFido, are tax deductible. You're driving out there, any other costs incurred for tolls, etc. All training is deductible if it doesn't qualify you for a different trade. So every designation, every certification, every course you take, all your CE requirements, and the cost of traveling there, and the materials you have to buy, and the meals you have to eat, the room you have to stay in, those are all tax deductible expenses. The NAR convention's coming up, all tax deductible. You're not meeting minimal educational requirements, so your CE classes are deductible. The licensing is what you could not deduct. So when you got your license, that was not deductible. After that, it's rare to find something that's not. But the only thing that's tough to write off is your clothing. Unless you're wearing company-based clothing with permanent logos on them, on a shirt or on a blazer or on some other item, those items would not be tax deductible. The cleaning of them, the taking care of them is deductible. Again, you're maintaining and improving your skills. So make sure you've taken all the tax deductions. Don't forget, you might subscribe to a magazine. I subscribe to a Chicago Tribune newspaper. Why? There's a real estate section in. There's a list of homes information in there. So by having that section, in fact, mine is sitting right out in my family room waiting to be read once we're done with this because I didn't read the Sunday paper yesterday. Those are deductible. The books you buy, seminars you take. Don't overlook all education and training. Number 5, automobiles. Every year, the mileage changes. Last year, it was 56 cents per mile. This year, it'll be out, and it probably is out right now. I haven't checked yet, but it'll be close to that. Could be a tad higher because gas prices went up. I doubt if it's going to be lower. But the point is, if you're a lower mileage driver, have high car payments or leases, the actual cost method might be better. If you drive a lot, taking the flat 56, 53, 57 cents a mile, whatever it is going to be a much better way to go. So based on your mileage, do it both ways, at least once, then get a feel. As I have lower mileage, now I don't travel as much as I did 10, 15, 20 years ago. I don't need that. But again, if you drive a long way because your market area is large, you're not concentrated, again, look at both methods. But, if you're putting in 30, 40, 50,000 miles at 55, 56, 57 cents a mile, that can add up real fast. You still can deduct your car washes, your tolls, your parking. But you also can keep track of things. Maybe your accountant will recommend you depreciate a car if you own it. Maybe your accountant will recommend that you should lease a car and write off the lease payments. These are the questions I want you to think about and then share with the people you rely on for professional tax advice. Every agent tends to be a little different, but I have found, as I said, a lower mileage driver with high car payments may have an actual cost method better than taking the flat mileage. Office supplies, office expenses, ink for your printers, any consumables, paper, copy paper, furniture you buy, any kind of machinery, copier, scanners, fax machines if you still keep one there, all the bills related to your telephone usage. If you have a landline and it's the only line in the house, a proportional share if you do 88.29 and don't take the flat fee. Or maybe on Schedule C, depending on what tax schedule your accountant is suggesting you use based on your particular situation. Now, many people only have a cell phone. They have no more landlines. That means you'll probably have to prorate that as to how you feel your expenses are. My guess is, in my personal life, I would imagine if I was writing off my cell phone as the only phone, I would have probably 85+% because I rarely get a lot of home phone calls. Especially if you block the spam calls. Meals. I said it earlier. I'm going to remind you again. This is the last year you can write off 100% of your meals as you go out for business purposes. So it'll go back to 50% like it was prior to COVID-19. So again, some people aren't aware of that and take 50%. So please check with your accountant to verify what I'm saying, because they're the final say in what you do. I'm just reminding, recommending, and hopefully getting you to realize there are some options that you need to check, again, to pay the least amount of taxes as you legally owe, i.e., a tax avoidance strategy. Now, can you go all out and spend thousands of dollars? If you're having a meal and you're justifying it, now remember, if you take a partner or a spouse who's not in real estate, you can't deduct that. If somebody brings a partner or a spouse or other guests who are not part of the business transaction. But if you're showing property to a husband and wife, you take them out for breakfast, lunch, or dinner, that's deductible. But if they bring their 2 kids, you might want to be careful of whether you should be writing off those kids' meals. They're not buying the houses. They're not your clients. Again, there's enough tax deductions legally to avoid taxes. So you don't want to get into a problem with evading taxes by throwing those in. It's your choice how you run your business. Obviously, you put anything down you want on a tax return. You can make up numbers every day. And until the day you're audited, everything is fine. See, you're basically innocent until they ask you for verifying your numbers. We'll talk about how automobiles get agents in more trouble than any in an IRS audit. Number 9. Many of you spend a lot of time in organizations. You belong to various groups. I'm a realtist and I'm a realtor. So I have realtist dues every year. I have realtor dues every year. I may belong to some other organization. I may have other licenses that need to be renewed in real estate. Maybe I have an appraisal license and a home inspection license or an auctioneer's license. My insurance, my E&O insurance, any other insurance I might have related to my business, my car insurance prorated if I don't take the standard deduction. But basically, all your fees and the costs of membership in those fees. And if you subscribe to magazines or websites related to news and information about real estate, those are all tax deductible. Now, remember, as an RPAC major investor, as a person who believes RPAC is our insurance policy, our RPAC contributions are not tax deductible. They've got to be separated from what you do. They're supporting a political action committee, and that's not a tax deductible expense. But any other types of things can be deducted fully. If you're using your office and have 1/10 of it being allocated because you're doing the regular method, 1/10 of your property taxes. You got self-employment taxes to pay, Schedule S, SE. We're going to talk about winning with ACEs in a few moments and building wealth by using ACEs. ACEs are good cards to have in a card game. But you've got deductions for your health care and other factors as a small business. Number 10, we're constantly upgrading our software, getting a new version of Office or a new version of Adobe or some other signature program that maybe your company doesn't provide that you want to have. Your CRM system you use, maybe some other places you subscribe online for materials. I subscribe to a service every month that costs me $47. That's tax deductible. I use that in my business. The cost of maintaining my domain. I'm Wayne at WaynePaprocki.com. I have to pay for that domain. That's all deductible. But above all, please make sure you have a good CRM or some other software that helps you track your expenses and your mileage. This is where the number one problem is for realtors across the country in an audit. They don't keep the kinds of extensive records required by the IRS to track their expenses for meals and for mileage. And those are the first two places the majority of IRS audits of realtors start. Show me some of your expenses for August, September, May. Show me some receipts for who was there, blah, blah, blah. Once again, nothing ever happens till something happens, i.e. the audit. So please do it the right way, do it the legal way, avoid taxes, and you'll have no problem getting the maximum benefits to reduce what you pay to the government. That's what you're supposed to be doing by law. Number 11, gifts. This is an interesting one. This also triggers some audits because many agents aren't aware that you cannot deduct more than $25 of the cost of business gifts you give to somebody during a tax year. And many of you as husband and wife teams give to the same person. That's considered one taxpayer because most of you file a joint return. If you send them something and there's cost of mailing or engraving, that's fine. Now, there are several companies that are used by agents, sometimes as pop buys, sometimes as closing gifts, that allow you to engrave your name or put your logo on there, and those are considered marketing, not advertising. Once again, please run that by your accountant. So these are looked at as marketing tools. In fact, some of the companies even offer to hold your inventory for you and give it to you as you need it to market. So when I'm giving you this closing gift, it's a marketing gift. My name's on it, my company name's on it. You get one every month to remind you of something. So just be very careful. Gifts, $25, marketing, unlimited. You have to make the best decision with your accountant's advice or your legal advice. But this is one that oftentimes, especially even on the lowest price home, a $25 gift is oftentimes not much. And so it was very easy to think, well, it's just a gift and they bought this X $100,000 or X $1 million property. They deserve something more than a $25 something. And you wrote it off. Nothing ever happens till something happens. Number 12, the dozen, health insurance. We're seeing a few more companies trying to offer it. We're seeing NAR with a policy. The bottom line is, if you provide health insurance to you and your family, and in fact, I would suggest strongly that you find a way to use your family as employees of your company. Whatever form of ownership you have is immaterial. But if you hire me because I'm your brother or your partner or your spouse or your children, they can be considered employees for tax purposes. And there's loads of advantages for example, your children being paid by you to do legitimate work for you. Maybe they're on the computer. You might have a 8, 10, 12, 15-year-old that can run circles around you on a computer, making flyers, printing out this, doing something there. Maybe they deliver stuff and hang it on doorknobs. Maybe they stand with you at a meeting and hand out items that you are a realtor. They could be given a salary, and that could be able for you to avoid those expenses. The IRS has a limit that a child can make before they have to pay any legal income taxes. Let's pretend it's $6,000 and you had 2 children. You paid each kid $500 a month to help you do stuff, and you could document what they did. That's $12,000 of income you don't have to report legally because it's expense against your business. Since they didn't make more than whatever that limit is, we use $6,000 as an example, they pay no income taxes. This is a win-win. You could open up a college fund. You could open up a fund when they get married. You could do whatever you want with the money. Money for them when they turn 21. And it's tax-free legally. Listen to this. Tax-free legally. Say that 5 times. Tax-free legally. Tax-free legally. Tax-free legally. Tax-free legally. Tax-free legally. Wow. It's music to my ears. I hope it's music to your ears. Legally and free. Sounds good to me. I guess I'm rhyming things today. Legally and free sounds good to me. So there's your 12. There's many more over the next few weeks we'll be covering as we get you planning the end of the year tax strategies for this year, but then also it's starting to be that time to think about the business plan for next year. But we're going to stick with end of the year strategies for the next few sessions together. And I'll be repeating some things and reminding you of some things. You're the person who has to do them. This is education. I appreciate you sharing your time with me. I'm hoping giving you something that says this was worth it. But education without application is worse than worthless. If you don't do this, it's costing you lots of money. Let's leave that for a moment. Let's move on to some safe harbor rules for rental real estate and for your personal business estate called the QBI, Qualified Business Income Deduction. You need to spend some time looking at the IRS forms or making sure your accountant is utilizing those forms as you prepare your tax return. The law is phasing out over the next few years. It started back in 18 when our president then created that tax benefit for us. And thanks to the National Association of Realtors and their lobbying efforts, we were considered an essential service. And we are qualified to take that 20% tax deduction, that 20% write-off of our income as a tax deduction. So the bottom line example, before we start my presentation on this, is if I made $100,000 last year in real estate fees, I could write off $20,000 according to QBI. Now you got to follow some rules and regulations, and it gets pretty high up there. But if you're making $400,000, $500,000, $600,000 a year, you're probably not going to get the benefit of QBI, but you have other benefits you could get. So since the majority of agents don't make that kind of money, remember, NAR put out something as of last September. If you sold more than 3 houses so far through September, you were in the top 8% of wage earners in this organization. So most of you will benefit from QBI. Most of you will benefit from QBI. Little background, couple of thoughts. There's a number of places on the internet you can find. This happens to be a title page from a law firm. They have information. All you have to do is search QBI for real estate or just QBI, and you will find loads of videos, loads of information that I'm sure your accountant already knows. If you do your taxes by yourself, you better read because they've got a lot more detail than I could spend. And again, they are legal counsel, but they'll still have a disclaimer like I did. You need to make sure the person you talk to is aware of some of these places if they are not. But this law firm does have a very good set of strategies, ideas, and just general information about how real estate businesses, whether you are selling and or investing in real estate, can benefit from what we have had going on for about the last 4 years. It's called Section 199A, Qualified Business Income. It allows some deductions that are amazing. It passes through income earned if it qualifies, as I said, up to 20%. So it makes a huge difference. Your insurance agent makes $100,000, you make $100,000. You're going to get a tax benefit, they won't. So this became part of the Tax Cuts and Jobs Act of 2017. You can read it in 120, and it keeps going on through 26. I'll show you in a few moments how it phases out. So it's been going on for basically 5 years, and it goes on through December 31st of 2025. So you have 22, 23, 24, 25. You have 4 more years left. If you've never used it, if you've been using it, you're probably using it for 5 years or maybe a few years less. But it could be extended by Congress. A lot will probably determine who's in office in 2025, 26, but it expires. But it created another source of income that receives preferential treatment, i.e. realtors. I just mentioned earlier, RPAC is not a tax-deductible expense. But people, because of RPAC and your contributions and my contributions, we now have something other people did not have. Many of you know people or yourself who made more money during COVID than you ever made before, and you're still doing well. So bottom line, the thresholds are for this year, $170,000 for single taxpayers and $340,000 for married taxpayers. So if you're married and you and your spouse earn $340,000, $100,000 less than adjusted gross income, you would qualify in the process. But again, discuss it, show it, make sure your tax accountant is showing you, yes, we did it, or no, we can't do it because. Tax Credit Jobs Act, Section 199A. There's forms you can download, instructions you can read. But my gosh, to lose this opportunity up till now hurts me to have to say, I wish you would have. But as of today, no excuse. Ignorance is bliss. You didn't do it 2-3 years ago. No excuse anymore. No excuse anymore. So, tax breaks. Basically, we're talking about very simple things. The fact that you can write off a lot of equipment. So all those things you have in your office, the computers, the calculators, the phones, the lighting. Maybe you've got your office set up to go on Zoom or to make live presentations to other people. All that equipment. I've got 3 screens here plus another screen I can use. I have 4 screens, all tax deductible. I've got a lot of lighting that's set up for things. Everything you see in the background, that credenza, all those books in there, all tax deductible. And it's well over $1 million. And the equipment you buy is a separate issue. But you'll notice this phases out, and I don't know if you can read this as much as I thought you could, but from September 17th through now, there was bonus depreciation, 100% bonus depreciation. Once again, all you have to do is say to that accountant, when I do my tax returns, am I getting bonus depreciation? 80% for property placed in service after December 31st. So you got some rules. It phases itself out 80, 60, 40, 20 by the end of 2026. Once again, all I'm suggesting is you'll be using what's called Form 4562 depreciation. You then ask your accountant, as that form is filled out, did I get bonus? Did you take bonus depreciation off? And let them explain to you they did, and here's what happened and how much you saved. Whoops, didn't want to do that. Hold on. Patience is a virtue. I clicked the wrong screen. So let's look at something else that's critical. It's the Section 179 deduction. This is where you can write off in full your depreciation. So far, I've suggested this. Form 4562 for depreciation. I'm suggesting you look at the Tax Credit Jobs Act to write off 20% on Section C or some other place you go. And now we're going to be talking about the benefits of 179. I'm going to spend more time on it next week, but I wanted to get you aware of this. So I'm hoping if you join me next week, at least you took some time to get some information online to take a look at Section 179, and then I can reinforce some thoughts that you found there. With that said, this is a process that has to be surrounding itself with many things just besides your business deductions. So here we go. Couple of thoughts from my perspective. This particular tax credit of 20% has been very good for many people. Again, if you've been selling a lot, you're not going to get the same benefit. But $340,000 for a dual income family, married filing jointly, should put you in some kind of tax benefit unless I'm missing something in what you're doing. So let's go back a minute. Your tax return is more than just your business deductions. And I made a statement. That said, you win with ACEs. And some of you have heard this before months ago. But I look at, in Wayne's world, Many people have wealth in different ways. I measure wealth not by how many dollars, but the relationship of your lifestyle and where you're at. $100,000 income in some area is a lot of money. Someplace else, it's hardly nothing, just like house prices. $100,000 house someplace is a nice house. Somewhere else, you can't even buy something for $100,000. And $1 million house in one market may be nothing. Take San Francisco, take a small community in any state, even the same states. I live in Cook County. We have the largest range of high to low prices of any county in the country between south suburbs and north suburbs. Kenilworth being the highest, communities down in the southern suburbs, Dixmoor, etc., much lower prices. The widest range of high to low of any county in the country is Cook County. Up and down, hour drive, huge difference. So I look at my taxes every year and say, where can I make the best inroads? And obviously, for most people, the tax laws have changed. So some of you may be following a plan with your accountant that I call the leapfrog plan. 1 year you itemize, the next year you don't itemize. 1 year you itemize, the next year you don't itemize. And you pool things together. So here we are, we're at the end of the year. If you have a mortgage payment, if you made your December payment in January of 2023 and made your January 2024 payment in December of 2023, this next tax year of 2023, you would have 14 months of mortgage payments and mortgage interest. And so then in 2022, you didn't itemize. In 23, you itemized. In 24, you didn't itemize. In 25, you itemized. In 26, you didn't. So you pool things together. Prepay medical insurance, prepay medical expenses, pay a doctor's visit, pay a teeth cleaning ahead of time, pay one in advance at the end of 2023 or 2024. You're leapfrogging, as I call it. So you're putting a lot of expenses every other year so you can itemize that year. Once again, tax accountant, tax advice is critical. In Wayne's world, I surround myself with people smarter than me. And a good accountant, a good attorney, a good contractor, a good anybody in this business is better than I am. They're on my board of directors, and I'm chairman of the board. So surround yourself for people you use in your business and in your personal tax life to build wealth. So I found out that as I look at people across the country, and I have the pleasure of being in 38 states and Peoria on a regular basis. I think maybe I'm at 39. Anyway, I noticed something. The people I talk to that seem to be, in my mind, comfortable with their lifestyle, earning amount of money they love to earn, and taking advantage of tax laws, win with aces. At any income level, I don't care if you're making 30, 50, 90, 100, 500, or $1 million. It doesn't make a difference to me. That's your choice. You win with aces. Wealthy people taking advantage of our tax laws fill out a Schedule A, Schedule C, Schedule E, and Schedule S. ACES. A is itemizing deductions. Now that's changed a bit because we've had some new laws with limitations on state and local taxes. So for many people, A is not a big one anymore. In fact, many people have moved much of their personal expenses over into their business. I recommended several times that people who have a first mortgage on their home, if they have income property, can they refinance one of their income properties or take a HELOC on their income property to pay off their first mortgage so they can deduct all the interest on the loan that's secured by their income property that's used to pay off their first mortgage? Because again, you may not get the full benefit. And so that's why we're seeing less and less people seeing Schedule A as a strategy to build wealth. If you have the pleasure of having income properties and have the pleasure of getting a HELOC or refinance, use it. Make that money work for you. So now all your personal home interest has been shifted over to residential real estate interest or business interest, which is tax deductible. moving your health care over to your business. A lot of factors for agents to spend time with accountants on, and attorneys if that's the case too, in terms of legal organizations, the LLC versus subchapter S versus whatever. I'm not here to talk about that. Schedule C or its appropriate schedule, profit or loss from business or profession. And the IRS has nothing wrong with losing money. If your income is less than your expenses, you have a loss, as long as you can prove that you're not doing this as a hobby. And we have certain rules in real estate. For example, the QBI for rental real estate is based on working, I think it's 250 hours a year. It's some ridiculous low amount of time, 750 hours a year, 15 hours a week on the average. Well, most people can do that. So you got some rules and regulations, but Schedule C, a lot of places to write off a lot of things we've talked about. Schedule E is my passion. Schedule E, rent and royalty income. It's the form that I have more pages to use than any other form I use, because I could put all my rental property on and all my royalty from books, materials, and other things. Rent and royalty income. Schedule E. That tells me you're buying at least 2 income properties a year and taking those tax benefits. Rent and royalty income. And then Schedule S is your self-employment. Because you are a self-employed person. We talked about getting half of that back on your schedule, etc. So there's rules and regulations about how that's handled. So ACES, you win with ACEs if you're maximizing your benefits in the way to avoid taxes in real estate. So as you put all this together, this is the time of the year. You're probably able very soon to download almost all the 2022 tax forms you need to fill out by April 15th. Some of the rules are still in draft, like the QBI. They're still issuing some draft papers yet, but we have a pretty good idea, as I showed you, what it's going to be. I doubt if it's going to change, but it's not official yet. Now, if you want to give everything to your accountant and walk away, that's your choice too. But all I'm suggesting is some key words. How are we doing on the QBI, Mr. and Mrs. Accountant? How are we doing to 4562? Did I take bonus depreciation? What about 199A? Where's that? Look at your last year's tax reform. Grab the last year's tax packet. Which forms that I've talked about have you used? Did you use the QBI last year? Made it under 340,000. I don't know why not. As a married couple, 170 as a single person. Did you use the 4562? Did you use 179 and write off without depreciating the full cost of something? How was your mileage handled on 4562 for your cars? If you have multiple cars, did you allocate? Then look at your Schedule A, look at your Schedule C, or a form similar to that, depending on your form of ownership, and then tell me, no, don't tell me, tell your accountant, how come I'm not using these? Could you show me why I don't have a benefit from using these forms? Now, there could be a few others that are specific to you. There could be some breaks by the states you're in. Some states exempt certain kinds of taxes. Some states have limitations. So you need to also make sure your accountant is handling your state income tax, because many times certain things are exempt from state income tax, and that can make a difference. Make sure you've deducted all the fees that sometimes are automatically taken out of your commission check. You're getting a net check, but the gross was more, and they show you the gross, but you didn't get that much because they have fees they take out for processing, for other things. Make sure you're maximizing every expense that you're allowed to take and don't lose out on missing expenses. With that said, let's go back to mileage and meals. The M&Ms, which taste good, but they can mess you up. You need to make sure you spend some time looking at the IRS guidelines or asking your accountant or looking some things online that will allow you. I'm sure if you go to the NAR convention, several of the booths out there will have some materials that are the best ways to track mileage. Many of you have a CRM system right now that makes it pretty simple. But once again, if you're not a record keeper and don't want to take the time and don't really care, then just take the standard mileage. 50 plus, 50 cents plus, probably around 56, 57, maybe 58 this year when it comes out. I haven't looked, but that's good. Plus all your tolls. And now with transponders, you can get a quick printout of all the toll booths you went through to document. I went from here to here and I paid this toll, blah, blah, blah. Go through those credit card statements. Now, I do know some agents, and this is their choice, they have several different credit cards they only use for certain different categories for tax purposes. So they use this credit card A for all their automobile expenses, this credit card B for all their restaurant expenses, this credit card C for all these items. And because, as you well know, many credit cards are offering tremendous rebates up to 5% on certain items. One's on clothes, one's on food. Some companies will let you pick the categories you want to take the maximum deduction on. So for example, I don't pay for much at Costco with my credit card unless I'm going to be writing it off, put on my Costco card. So if I bought food for a broker open at Costco, I'll put it on the credit card. If I go in to buy personal items, I just pay cash because they won't take anything but that Costco Visa. But I always use my Costco card for any gasoline station, 4% cash back. Not 2, not 1, 4, always, any station. So I'm driving last night and a station has gas in Illinois for $3.69. $3.69 with my Costco card, 4% off. That's another over 12 cents. So now I'm down into 350s when somebody else is paying maybe well over 450. So if you like that strategy, some people that pay cash use envelopes, envelope for food, envelope for clothing, envelope for this, envelope for that. Maybe a couple credit cards just devoted to those expenses or a few expenses would make it easier at the end of the year to sort things out. Just a suggestion of people I've talked to that have found a better way of doing it. Much of this stuff is automated. Like I said, the CRMs have a lot available. So we could spend all day looking at more tax benefits, tax deductions. I do realize that because many of you do eat out on the road. The cell phone. You should never go through a drive-through without ordering ahead of time with your credit card in there already, especially if you got clients in the car. If you want to go in and sit down, that's fine. If you want to just buy it to eat, but because it's here, there's always specials. Every single day since I've had my app from one of the major franchise food chains, they have a buy one, get one free. Some of their sandwiches at $4.79, buy one, get one free. Their drinks, sometimes there's free food, free fries one day, dollar fries if you buy over $3. You cannot be a realtor who frequents drive-thrus. I'm not saying that's the best way to live, but if you go through them, whether you're just buying a coffee or a latte or a shake or anything, this is it. Every single drive-thru. I probably got 5 or 6. Do I use them a lot? No, but if I'm going to go by and I want to do it, I'm going to see what's this one have, what's that one have. You also find that many of you have shopping apps at the grocery stores you buy groceries at, and restaurant apps. And unfortunately, a lot of people waste a lot of money by not taking advantage of what's available through the phone and apps. So we covered a lot of things. Again, the key numbers, the key forms we've alluded to: 4562 depreciation, 199A qualified business income, 179 accelerated depreciation, Schedule A, Schedule C, Schedule E, Schedule S. All those together create a tax avoidance strategy that says, I want to pay the least amount of taxes. And here we are. Again, been a pleasure. We're going to continue next week with some more tax ideas, advice, and reminders. One last time, you got 1 week left to go to treasury.gov, up to $10,000 in an I-bond, paying 9.62%. You got to hold it for a year. What a good, safe way. Enjoy the season. If you're in an area where leaves are changing, enjoy that. If you're in a warm weather climate, enjoy that. I am so happy that you choose to join me in Wayne's World and hopefully building wealth. Don't forget, 2 income properties a year. See you next week. Have the best week you ever had. And let's get ready for 2023. But let's make sure you practice tax strategies to end 2022 without paying too much money in taxes.